In this video, I'm going to be talking about a protocol that a lot of people in the industry are excited about and that currently represents around 5% of my portfolio. So yes, in this video, I am going to be pumping my own bags, and the protocol we're going to be talking about is Synthetix. Now, by the end of this video, I'm going to be answering the question of why so many people are excited about Synthetix protocol and why they're so bullish on it. I'm going to be going over how the protocol works. We're going to take a look at how I'm going about valuing the token. And then we're going to wrap it up by covering a few of the risks that you should be aware of if you're going to be investing in the Synthetix token. So with that, let's jump into today's video. Now, to explain why so many people, including myself, are bullish on the Synthetix protocol, first we have to just briefly talk about how the protocol actually works. Now, if you're familiar with MakerDAO and how that protocol works, then it's going to be very easy to understand the mechanics behind the Synthetix protocol. The Synthetix protocol allows users to create synthetic assets that can track the value of any asset that has reliable price data. This includes Forex, stocks, real-world assets, and other crypto assets as well. Now, these synthetic assets are called synths, and users can create synths by locking the Synthetix token SNX into a smart contract. When users lock Synthetix token into the smart contract, they mint SUSD, which is a synthetic stablecoin that is pegged to the US dollar. The amount of SUSD that a user mints is proportional to the amount of SNX that they have locked into the smart contract, and this SUSD that they have minted represents a debt position held by the staker. Now, stakers have to manage this debt position by ensuring that their collateralization ratio remains above a specified level. And in return for managing their debt position, which subsequently is maintaining the health of the entire system, stakers earn a portion of all trading fees generated by the protocol, as well as being paid inflationary SNX tokens as an incentive to provide liquidity to the protocol in the early stages of its growth. The amount of SUSD that a staker mints when they lock their SNX into a smart contract is determined by the issuance ratio, which is currently 500%. Now, this issuance ratio also determines the collateralization ratio that a staker must maintain in order to be able to collect any rewards paid out by the protocol. So, for example, if a staker locks $1,000 worth of SNX into the smart contract, they're able to mint $200 worth of SUSD. Now, their collateralization ratio would be at 500%, and if their collateralization ratio ever falls below 500%, then that staker is not eligible to collect any rewards from the protocol until they get their collateralization ratio back up above 500%. This is how the protocol incentivizes stakers to maintain the health of their debt positions, as well as the overall health of the entire Synthetix protocol. Additionally, the protocol maintains the integrity and health of the system by liquidating a staker's position if it falls below a specified level. So these are the two mechanisms that the Synthetix protocol uses to ensure the integrity and security of the protocol. So that's an overview of how the Synthetix protocol works from the staker's perspective, but the reason why so many people are really excited about Synthetix is because of how the protocol works from a trader's perspective. So now let's jump into how that works, and this is what's going to explain why so many people are so excited about the Synthetix protocol. Now, there are a number of reasons why Synthetix is exciting, but the main one is because of the trading mechanism that is used by the protocol. Rather than the common peer-to-peer trading mechanics that we're used to, the Synthetix protocol uses a unique peer-to-contract trading mechanism. Now, essentially what peer-to-contract trading is that a trader who wants to trade one of their synths, like SUSD, to another one, like SBTC, doesn't have to go and source liquidity and a trading price from a counterparty in a peer-to-peer market, such as a decentralized exchange. Rather, the Synthetix protocol allows traders to use Chainlink oracles in order to immediately convert one synth to another. Now, the reason why this trading mechanism is so important is because it results in zero price slippage and it results in infinite liquidity. Now, the reason why this peer-to-contract trading mechanism is possible in the first place is because all synths on the protocol represent a debt position held by stakers on the protocol. So none of the synths are actually backed by the underlying assets, they're backed by the Synthetix tokens that are locked in staking contracts. And this is what allows for the peer-to-contract trading mechanism that is used by the protocol. Now, you might be thinking, well, doesn't that open up the stakers to the risk of their debt positions becoming overwhelmingly large to the point that they become insolvent? And the answer to that is yes. Stakers are liable for their proportional share of the entire debt pool held by the Synthetix protocol. So if the majority of debt, which begins as SUSD, is converted to SBTC by traders on the platform, then that would mean that the majority of the debt pool would consist of SBTC, which means that debt holders are now exposed to the risk of the price of Bitcoin rising. So if there are some stakers on the protocol who held SUSD, while the majority of the debt pool on Synthetix was composed of SBTC and the price of Bitcoin rose, then those stakers who stayed in SUSD would be liable to burn a larger amount of SUSD tokens than they had originally minted. Now, of course, this mechanism also operates in the opposite direction. If the majority of the debt pool consists of SBTC and then Bitcoin crashes, as it did over the last few weeks, then the stakers who were holding onto SUSD would have to burn a smaller amount of SUSD to unlock the Synthetix that they posted as collateral in the staking contract. Now, this is something of critical importance to understand if you're going to be staking SNX tokens on the Synthetix protocol. Because if you're going to be a staker on the protocol, you're going to be exposed to the risk of changes in the value of your proportional ownership of the debt pool. So that means that you want to be making the right decisions with your debt position on the Synthetix protocol, and the decision you make is going to be depending on the distribution of synths across the Synthetix protocol, which you can view from the protocol's stats page. Now, right now you can see that around 40% of the protocol's debt is comprised of SUSD, but there's still a lot of exposure to other synthetic assets like SETH or SLink or other synthetic cryptos that exposes you as a staker to various risks. So what you want to do on the protocol is you want to hedge your bets either by converting a portion or all of your SUSD tokens to another synth, either to reflect your bullish sentiment on one of the synths or just to mimic the overall distribution of the synths within the debt pool, or you can hedge outside of the Synthetix protocol by going long or short on specific assets depending on what kind of exposure you want. But the idea is that you as a staker should be actively managing your debt position because after all, you are the one that is maintaining the health of the Synthetix protocol. And because of this work you're doing, you're being rewarded by being paid a portion of all trading fees that happen on the protocol as well as inflationary SNX. Now, this peer-to-contract trading mechanism is also important for the protocol and for stakers because it keeps trading activity within the Synthetix protocol. And the reason why is because the peer-to-contract trading mechanism allows for zero slippage and for infinite liquidity, something that you can't get if you're going to be trading assets on a decentralized exchange or even on a centralized exchange. Now, this is vital for the success of the protocol because if traders were able to source better executions on decentralized exchanges or centralized exchanges, then volume would move off of the Synthetix protocol, stakers would earn less fees, there would be less of a reason for stakers to maintain the integrity of the system, and the entire system would be compromised and fail. So this unique peer-to-contract trading mechanism is not only useful for traders, it's also useful for the protocol and for stakers as well. Now, jumping into the final reason I'm going to be talking about in this video of why people are excited and bullish on Synthetix token is because the protocol is actually generating substantial cash flows for stakers already. Right now, stakers are earning around a 30% annualized yield for staking their SNX on the protocol. Now, around 24% of this yield is a Ponzi yield, which is coming from inflationary SNX rewards that are being paid to stakers as an incentive for adding liquidity to the protocol. But just over 5% of this yield is real yield coming from actual trading fees being collected by the protocol. And what's really interesting about this is that this 5% yield is coming from just around 9,000 unique traders and an average of just 57 day traders. So really, on the grand scheme of things, there's almost no trading activity happening on this protocol, but the protocol is still able to generate a significant yield for stakers. Now, once synths become integrated with other DeFi protocols like indexed DeFi products or various other DeFi protocols, then the trading activity that's going to be happening on the Synthetix exchange is going to rise significantly, and it's going to be pretty easy to integrate synths into other DeFi products because of the fact that synths are ERC20 tokens. So as synths are used more in other DeFi protocols and as the trading interface actually just improves over time, then more trading activity is going to be happening on the Synthetix exchange, which is going to generate more fees for stakers and is going to draw more people to buy and stake their SNX on the protocol. Now, because the value of a Synthetix token is essentially derived from the income that a staker is able to generate, we can create a valuation model based on expected future yield generated by the protocol. Now, coming up with price targets based on expected future volume and trading fees generated by the protocol seems a little bit inappropriate and irrelevant given the stage of the industry lifecycle that we're at. The broad assumptions that I'm basing myself off of for why I'm so bullish on Synthetix is because I think that the peer-to-contract trading mechanism that was instituted by the protocol is revolutionary and it creates a significant competitive advantage for the protocol. And on top of that, I think that derivatives are grossly underrepresented in the DeFi market as a whole. In the traditional financial markets, derivatives represent around $1 quadrillion of value compared to in the DeFi markets. Right now, it's around $2.5 to $3 billion. So for that reason, I think that the derivatives market within the DeFi industry represents one of the greatest areas of growth within DeFi. And right now, Synthetix dominates that market. It's around 56% of the value locked within the entire derivatives ecosystem on Ethereum. Now, there are three broad questions I think you should be asking yourself before investing in the Synthetix protocol. The first question is, do you think that the peer-to-contract trading mechanism used by Synthetix, which allows for zero slippage and infinite liquidity, represents a competitive advantage that can draw a lot of volume onto the platform? The second question is, do you think that the derivatives market within DeFi is currently underrepresented and represents a strong area of growth? The third question is, do you think that Ethereum will be the DeFi layer 1 blockchain of choice, or at least one of the dominant chains within the DeFi ecosystem? Now, if your answer to all of these was yes, then I think you know what to do. Now, of course, when investing in DeFi and protocols like Synthetix, there are a number of risks that you should be aware of. Now, the first one is the one that we already covered, which is the fact that stakers are the ones who maintain the integrity of the system by managing their debt positions. Now, of course, if stakers become complacent or something systematically goes wrong within the system, then everything can be compromised. However, I think that based on how high of a collateralization ratio that the protocol uses, the risk of this is relatively low. But this also leads into another problem, which is the fact that the protocol is very capital inefficient. The fact that the value of the synthetic assets that can be created by the protocol can only be 20% of the value that is locked to maintain the system means that the system is extremely capital inefficient, and that places a limit on its total growth. Now, over time, I think that the team is going to be coming up with strategies on how to make the protocol more capital efficient. But for now, that's something that you should be keeping an eye on, because right now being so capital inefficient is not great for its long-term growth prospects, because it means a lot of value has to be locked into the protocol to enable for a lot of value to be created with synths. Now, the third risk comes from layer 2 scaling solutions. Synthetix has opted to integrate with Optimism right now, but right now for me it seems like Polygon is probably the best solution that's going to emerge as a winner. Now, obviously, layer 2 scaling, it's really early and hard to tell who is going to be winning. But right now, Polygon, the technology that they have is integrating with side chains, plasma chains, optimistic rollups, ZK rollups, and they're trying to create an internet of EVM compatible blockchains. And I don't know if Optimism is going to be able to compete with them long term, because Polygon is going to be creating their own optimistic rollup product as well. So with that, I think that Synthetix might be making the wrong decision by going with Optimism so early, but they of course reserve the right to be able to shift over to Polygon in the long run. So I don't think this is a massive risk, but it's definitely something you want to be paying attention to. And also, if you do want to stake your assets on layer 2, you should be careful because of the fact that there's not really much you can do with your debt position on layer 2, since there's not that much built on Optimism yet. Now, the last few weeks in crypto have been absolutely hell, and I hope for all of you watching that you're hanging in there and not getting discouraged. Extreme levels of volatility are the price that you have to pay to be an early adopter in this space, and that's true for crypto, but more specifically for DeFi, which is even more untested than the broad crypto market with assets like Bitcoin and Ethereum. My investment portfolio is 100% allocated to crypto, and I was not expecting a drawdown like the one that we saw, and I didn't hedge any of my positions, so I got hurt pretty bad by this drawdown. But with that being said, I continue to buy my favorite projects on a weekly basis, and the reason why is because the long-term fundamentals are largely unaffected, still intact, and in my opinion are getting better and better on a daily basis. And I also think that investing in crypto, and more specifically within DeFi, represents the greatest investment opportunity of this generation. And I think that you're going to be outpacing the returns that you're going to get in any other asset class by investing in crypto, which is why I don't use leverage in crypto. My goal is just to stay alive in the crypto game and add to my position on a weekly basis. So that does it for this video. I hope you guys enjoyed, and I look forward to seeing you all in my next video.